When it comes to investing, the stock market can be very overwhelming. Hundreds of ratios, loads of financial jargon that doesn't make sense to you, but the truth is there's really 7 numbers that you need to look at to get a strong picture of how a business is doing before taking a further deep dive. Today I'll walk you through those 7 magic numbers that you should look at first when seeing if a company is worth investing in, and to explain why it matters, I'm going to use Nvidia, which is one of the hottest stocks in the world at the minute, as a case study to help you understand a little bit more. First up is the market cap of a company, and this is simply the company's overall value on the stock market. So this is the stock price multiplied by the number of shares available, and this tells you the size of the business and its risk profile. Usually companies are grouped into 5 different categories, ranging from micro cap, which are companies worth under $300 million, and mega cap, which are companies that are higher than $200 billion, and these are normally the dominant giants. Right now, Nvidia's market cap is over 2.5 trillion, putting that firmly in the mega cap category alongside Apple, Microsoft and Amazon, just for scale of how big these companies are. This signals both dominance and lower bankruptcy risk, but also that means expectations are sky high for how the company is going to perform. So an overall rule of thumb, the smaller the market cap, the riskier it is to invest, because they've got less financial backing behind them, they're not as dominant in their market, and they could easily go under. Next up is revenue, and this is simply how much money a business makes in a year, and this is before costs. So in fiscal year 2024, Nvidia revenue hit $60.9 billion, which was up from $27 billion the previous year. So very strong performance, and that was largely driven by their GPU and AI data center demands. So revenue growth shows demand for the product or the service that the company is providing, and a company that isn't growing revenue over time isn't growing. And if you start to lose the revenue, you're really going to have to look into that business and understand why, to see if there's another factor behind that's driving it. Is it a macro effect? Is it a micro effect? And are they going to get out of that little decline in the future? The third number that you need to look at is gross profit. Revenue is great, but gross profit is revenue minus the cost it is to make that product or carry out that service. So this is how much the company keeps after selling the product. So Nvidia's gross margin in 2024 was staggering. It was 74%. So that means for every $1 of sales, Nvidia kept 74 cents after direct costs. So for comparison, chip makers like Intel often run closer to 50%. So Nvidia really is number one in their market. High gross margins equals better pricing power and strong competitive advantage. However, gross profit doesn't tell the full story. Number 4 on the list is operating profit. So companies have to pay for other things such as R&D, marketing, administration, energy costs, all of that. So that's why we need to look at operating profit, also called EBIT. This number gives you a realistic picture of profitability once all of the day-to-day costs and product costs have been taken into account. So in 2024, Nvidia's operating income was $33 billion. So nearly half of the revenue, which is really, really good. For most companies, operating margins are around 15 to 20%. A solid, Nvidia is running at 50%. So really, it just shows how effective companies can be, but on average, they're around 15 to 20%. The next figure that you need to look at is free cash flow. So counting profits are nice, but what really matters is the free cash flow. Free cash flow is how much cash a company generates after covering all operating expenses and capital investments. Positive free cash flow means that a business is generating more cash than it spends, which is money that I can use for dividends, share buybacks, or future reinvestment My personal preference at this stage of my investing is reinvestments or buybacks. But yeah, that's all the 3 different ways that a company can return money to shareholders. Nvidia's free cash flow in 2024 was about $27 billion. So that's just showing that Nvidia is not just doing profit on paper, it is making proper cash from its business operations. And the likes of Nvidia really reinvest a lot more of their cash than they do by paying it out in dividends. So yeah, solid business, solid numbers for Nvidia. The 6th figure that you need to look at is net cash or net debt. So you need to take a look at the balance sheet for this, which you'll find in company filings, and this is total cash minus total debt. Now be aware, debt isn't always bad. It can fuel growth, and if it is used correctly for growth, then it is a really positive thing for a business. But in a high interest environment, debt can be quite bad and catastrophic for a business. Recently, off the top of my head, Morrison's, their debt was really high. Obviously inflation around the COVID year just skyrocketed, so the cost of the debt was more than what they were making themselves. So yeah, you just got to look out really. You need to know why a company's got that debt and how they're using it, and how long it's going to take them to pay that back. So in 2024, Nvidia had about $25 billion in cash, must be nice, $9 billion in debt, so that left it with a net cash positive position of $16 billion, which is extremely healthy, meaning that they're not dependent on borrowing to survive, and if they wanted to, they could pay that debt off immediately and have no debt left. The 7th and final numbers you should be looking at when you're looking at a stock is valuation ratios. So we can't ignore things like price to earnings or PE ratio. So Nvidia's trailing PE is around 70, so that means investors are paying $70 for every $1 of earnings, which is extremely high to a lot of companies, and in the tech space that was just the usual anyway. But forward PE based on expected earnings is closer to 40, so that suggests that Nvidia's profits are going to grow into their current share price. So if you're looking at a stock and it's got, let's say for wild sakes, 110 PE, so you're currently paying $110 for every $1 it makes, but next year's forward PE is $70, that means they're going to grow into that, and that's going to come down quite a lot. So basically the higher the forward PE comes down, the quicker they're going to grow into that valuation. So high multiples mean investors are pricing in massive growth. That's what you got to look out for. If Nvidia delivers, the stock can keep climbing, but if not, high valuations can go both ways. It could quickly fall as quick as it could climb. So there you have it. They are the 7 numbers I think you should look at when you're first looking into a stock, to then understand the situation of the business and decide if you should research that stock further. This shouldn't be the be all and end all when you're doing your due diligence on a new stock or investment, but it is a good starting point. So those 7 are market cap, revenue, gross profit, operating profit, free cash flow, net cash debt, and valuation ratios. Together, you'll get a clear and balanced view of a size, profitability, and financial health of a company. Nvidia makes a perfect case study for a company that's doing everything right, because it's dominating its position and it is absolutely smashing it in all metrics on these boards. But the lesson is, whether you're looking at a $1 trillion company or a multi-million-dollar company that is a micro cap, all these things can apply and paint a really, really good picture of if the company is going to be worth it. Which of these numbers do you pay close attention to when you're investing? And drop a comment below. Don't forget to like and subscribe for more videos like these, where I run through investing tips, my investment portfolio, what I'm buying and why I'm buying it, and other investment news.